stocks are supposed to be stronger than the metal in a bull market. That wasn't the case. But of course, that's why I was pounding the table, especially early last year. In fact, I put out a special report, I think in April, the best way to buy gold, and that was buying gold stocks, because gold stocks had barely gone up on the year, even though gold was above $3,000 an ounce. Well, the GDX, which is a gold stock index, finished the year up 153%. And the GDXJ, which has some mid caps, more mid caps, it's called juniors, but they're not really juniors. They're just a little bit smaller than the GDX. That index was up 166% last year, and off to a strong start again this year. The GDX is up 8% so far in 2026, and the GDXJ not that much farther behind, up about 7.2% so far on the year. But these stocks are now outperforming the metal itself, which means now everything looks like a bull market. You can't say, well, you're not seeing a confirmation in silver, because we are. Oh, we're not seeing it confirmed by the mining stocks. Well, we have. And in fact, one thing about the mining stocks is that even though they've outperformed the metal, they didn't outperform it nearly enough, given how much gold and silver prices have risen and how great an impact that's going to have on earnings of these mining companies. Stocks are still very cheap. And that's still, to me, a positive contrarian indicator, in that the investing public still doesn't appreciate how cheap these gold mining stocks are and silver mining stocks are. They still don't get the significance of the bull market. They're still distracted, by the tech bubble or the crypto bubble, and they're not really paying attention to this opportunity, which is why investors should still be buying not only physical gold and silver at these prices, but especially the mining stocks. And, the gold mining stocks, not only are they going to make a lot more money because the price of gold is going up, but look at oil prices. Oil prices are below $60 a barrel. They're about $58 a barrel. That is the most significant cost in gold mining is energy. And that's going down. Now, I don't think oil prices are going to stay down, but they're down now. So this is great for the profits of the gold miners. But also, silver going up is going to have a major impact on gold mining companies, because pretty much all the gold mining companies mine some silver. It's a byproduct of gold. And the way they report it, it's not earnings from silver mining, but the money they get from their silver, they use that to offset the costs of mining the gold. So that means not only are mining costs going down because of low energy prices, but because they're getting so much from their silver byproduct. That is dramatically reducing the cost of their gold, and it is going to be reflected in their earnings. So all the gold stocks are going to benefit from higher silver prices, even though people aren't buying them because they're silver miners. They still mine a lot of silver, and it makes a big difference on their net costs of mining gold. And of course, there are companies that just mine silver, and they were the star performers of 2025. But again, given how cheap they were when the year began, they're still cheap now, despite tripling and quadrupling on the year. So even though we've seen this rally, you want to buy gold, you want to buy silver. Gold, I don't think there's very much downside risk at all. I don't think gold's going below 4,300. So if you're buying it now at 4,500, I think there's minimal downside in gold at 4,500. Right? Silver, a lot more volatility, which to me makes sense given the magnitude of the breakout. Right? We blew through 50. I mean, we basically paused there for a couple of weeks maybe, and I was forecasting on this and on my main podcast that once silver broke above $50, it was going to be a moonshot and that 50 would be support. Well, 50 was only support briefly. I believe support is now 70. I don't think we're going down to 50 at all. The opportunity to buy $50 silver is gone. And I hope a lot of people took advantage of it before it left while it was here. In fact, all last year, I told people buy 30, right? 30 is the new 20. Silver's not going below 30. Then I said buy 40, 50. Now I'm telling people to buy $70 silver if you get the opportunity to buy $70 silver. The low of the pullback after silver got above 83 was just above 70. And ever since silver got above 80, it's never been below 70, although it's gotten down there. I think the real support zone is 71 to 75-ish. So that's probably the best place to buy it. But the problem is, I wouldn't wait for 71 or 72. I just buy it at 79, because here is the problem for long-term silver buyers. I'm talking about physical silver. I'm not talking about people who want to trade it on the COMEX, doesn't really matter. I'm talking about if you want actual silver delivered to your house, like we do at Schiff Gold, you just got to buy it now. And that's because I expect the premiums on silver products to soar in 2026. So you've got two things that are going to happen. You got the price of silver is going to go up, but the premium on the products, what you have to pay to actually buy a 1 ounce coin or, a bar, is going to go way up because of the supply disruption. There's simply not enough physical silver being mined to meet the demand that we're going to see. China already has an embargo. They're not exporting any silver, and they're the world's largest producer. Investors are now starting to wake up to what's happening with silver, and there's just not enough of it. So the premiums are going to go up. So even if you get lucky and you wait for silver to pull back to 71 or 72, by the time it does, the spread or the premium that you have to pay on the products may have widened by so much that it's actually more expensive. So I think if you're a physical silver buyer, you got to buy it now while the product is available, while we can get it. I mean, I have a feeling that later in the year, we're going to be out of stock, right? You're going to want to buy physical silver. We're just not going to have it to deliver. That's going to be the problem. Or maybe we can get it to you, but the delivery times are going to be later. Right now, what I can tell you is we've got the supply. We haven't had to really increase the premiums. So it's available. Buy it. Buy it while it's available. Now, of course, if you don't need physical delivery, that's not as big an issue. And of course, I still think that everybody should open up an account with T-Gold. That is the part of Schiff Gold that deals with the storage program that we're doing, that we're going to build up to an e-commerce platform where you're going to be able to take delivery of tokenized gold and tokenized silver probably too. But right now you can buy gold and silver and not take delivery and leave it on the T-Gold platform. So you can do that too. But when you're buying for your own storage, for your long-term, self-custody, you just got to buy. Forget about the fact that it's $79, $80. Just be glad you can get it, because silver is going to be very, very scarce very soon. And the price, I think, will be a lot higher. And again, this is not just a precious metals bull market. Copper got above $6 this week for the first time ever. So it's all the market. Look at nickel, look at zinc, look at lead. I mean, prices are going up. And again, it's not just going to be metals. Agricultural commodities, I think, are going to really boom. Eventually, you're going to see oil go. I mean, it's held these lower levels longer than I thought. But even with what's happening in Venezuela, and I'm going to mention that later in this update, but I think that oil is looking strong and is bottoming. But this is a inflation-fueled commodity bull market, but also a supply shortage because of decades of underinvestment in capacity, in exploration, in development. So it is a perfect storm if you're long precious metals, but it's a disaster if you need to buy them, or if it will be for the industries that need them. But right now, investors need to take advantage of the fact that the prices are still not anywhere near where they're going to be, and we still have the supply. On the gold and silver mining stocks, I think as good as last year was, it's possible that this year could be even better. That's how cheap these stocks still are. So I would buy them. Now, the best way to buy them right now is with my Gold Fund, the Euro Pacific Gold Fund. The symbol is EPGIX. That's the no-load symbol. My Gold Fund was only up, I don't know, it was about 120, I forget how much percent last year. It underperformed the GDX and GDXJ because about a third of my Gold Fund is in real junior miners, right? Not the big companies in the GDXJ, but real juniors, not mid-tier, little guys. And they didn't have anywhere near the big move that the big ones did. But I think 2026 is the year they not only catch up, but they surpass the big move, the big stocks. Just like silver caught up and surpassed gold in 2025, the juniors, the true juniors, are going to catch up and surpass the seniors, I think, in 2026. And the best way to play that move right now is with my Gold Fund. Euro Pacific Gold Fund, EPGIX is the way to buy that, or contact the brokers at Euro Pacific Asset Management. We also do separately managed accounts in the mining stocks where we have significant weighting into these junior mining stocks. Now, what's going to be powering the precious metal bull market in 2026 is going to be de-dollarization, inflation, and a highly accommodative Fed. We know that Trump, I think he said he's made his decision on which of his flunkies is going to be installed to run the printing press in mid-2026, but they are going to run it nonstop. In fact, an indication of what Trump wants to do at the Fed was shown just this week with Fannie and Freddie, the GSEs, where Donald Trump is now ordering the GSEs to purchase $200 billion worth of mortgage-backed securities. Why does he want that? Because he wants to use government to reduce mortgage rates by buying mortgages, right? It's his own kind of mini QE run through the GSEs. Now, of course, where are the GSEs going to get the $200 billion? Well, I suppose they got to take it out of treasuries, because where is that $200 billion? It's just not sitting, in cash. It's probably in U.S. treasuries. And so they have to sell those treasuries to buy mortgage-backed securities, or it's money that the GSEs would have given to the U.S. government, reducing the overall deficit and the amount of U.S. treasuries that the government has to sell. But if now they're not going to get that money from Fannie and Freddie, they have to go into the market and borrow it. So this is kind of like QE, but what it is going to do is it's going to be inflationary, and it is going to push up rates on government debt as it somewhat temporarily reduces mortgage rates. It should do that in the short run. But this is an indication of what's going to happen. And, by the way, Trump's policies on housing are horrible. Not only trying to get more credit by having the government buy mortgages, right, which is, of course, one of the main reasons we had the 2008 financial crisis was because Fannie and Freddie were the biggest buyers of subprime mortgages, and they helped to fuel that bubble. But Trump earlier in the week announced that he was going to ban institutions, large institutions, and I don't know where they're going to draw the line, but he's banning large institutions from buying single-family homes, right? Because he thinks that they're driving up the prices by buying single-family homes. I would agree that those buyers help support the price, and without those buyers, the prices will come down a bit. That's probably going to be the case. But apart from the fact that this is completely unconstitutional, right? Trump has no regard whatsoever for the U.S. Constitution. That's clear, right? I mean, the federal government has no constitutional authority to ban certain parts of the economy, certain buyers, from buying single-family homes if they want to. But what are large institutions doing with the